Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Held the recent range, kind of coiling a little bit. We're starting to find ourselves waiting for that next IT event as the market sort of is waiting after popping up to new year-to-date highs last week and then quickly reversing those highs. We've sort of found a home. We did not get below the old high, which is 312 in the 10-year note yield, after trading as high as 3.25. So right now the market just sort of waiting for that IT moment. We have FOMC minutes this week. Will they be as hawkish as expectations were when they announced the statement back in September? Likewise, we have some housing data coming out later this week, which could also be a thorn in the Fed's side if that doesn't turn around. Today we got retail sales, not a very pretty number. So right now the market kind of edging on the side of caution as we see yields holding the low end of the recent range. Didn't extend the range lower today, but holding at the low end of that range. And if we look at implied volatility, the fact that we made that market big swing higher last week, we saw volatility rally. We actually saw volatility rally on the pullback as well. But today, as the session wore on, we started to see volatility decline, which suggests to the market watchers that we're going to go back into that old range. Now that's a big jump to go from 325 back to south of 3%, and I doubt we're going to do it all in one day, but it certainly means that if the data doesn't support where we've headed, that the market could see a reversal at least back below the old high of 312, get us back into that comfort range, and that would suggest that why volatility is going lower. And lastly, let's take a step back for a moment here and look at the macro picture. June of 2007, the range from June of 2007 down to July of 2016, we see a massive range. We're nearing the midpoint of that, as we were north of 5% yields back then, and we were south of 1.5% yields in July of 16. So right now we're kind of 230 is kind of the midpoint of that. We did not get there. Excuse me, 330 is the midpoint of that. We did not get there. However, we got very close as we've been in a long time. And if you look at what's happened over those years, yeah, we've had 3 presidential elections. Yeah, we've had a Brexit announcement. We've had what, 8 Fed tightenings, 3 Fed chairmen. And I think that right now the market is really starting to absorb all that as we get to that midpoint. Probably one of the reasons why we started to see the market slow and sellers kind of back off a little bit. We did see hedge funds and speculators back off some of their shorts as we neared those levels of 3.25. So right now, maybe just a waiting game. We're looking for yields to pull back. Could get back as low as 3% before they reload their shorts. But I think right now, the fact that we've made such a big move in such a short amount of time suggests that the market may be looking to absorb and see what comes next. There still is a lot of uncertainty in the market when it comes to not only U.S. data, but when it comes to what's happening in Europe, when it comes to midterm elections that are coming up here in the U.S. next month. Likewise, what is going to happen between China and the U.S.? We could get some details at the G20 at the end of November. The last I checked today is only October 15th. So that's a long way off. So right now the market is kind of finding a home, not pushing those, extending those yields that we saw last week, but not seeing a massive pullback either. Could it take some of the data that we're going to get later this week to make those things happen? This is Todd Colvin coming to you from the floor of the CME Group.